Good evening. Here's Doc Severson for the Theo Night Report for Thursday, March 22nd. Lots to talk about tonight with the S&P down 72 points, the Nasdaq down 192, the Dow itself down 760, and the Russell down 38 points. This is the market just shut a couple of minutes ago. What we're going to talk about in tonight's report is really three things. First of all, I'm going to talk about markets and intermarket relationships. I'm going to talk about swing trades, and then finally we're going to finish out today with intraday trades. Yesterday, Jerome Powell raised the Fed funds rate by a quarter point and indicated that there were another 2 or 3 rate hikes planned for the rest of this year. And based on what we are seeing here between the TNX, or the 10-year note, showing the interest rate of about 2.8%, and certainly in a rising environment, rising trend there, and also the TLT, and the TLT in this case is the 20-year Treasury bond ETF, which runs inverse to rates. I think everybody up until yesterday was thinking that a rising rate environment for the rest of this year was just a done deal. But there's a couple of problems with that scenario. First of all, can we deal with the interest rate payments on our current debt levels if we continue to raise the interest rate? And secondly, if we institute tariffs to protect domestic industry and start a trade war, will that disrupt the overall economy? So all of those questions hung on the minds of investors today, and like the old pit traders used to say, when in doubt, palms out, and that meant selling today, and a lot of that was driven by the financials, since they would be one of the biggest beneficiaries. So let's look at the XLF here. The financials would be one of the biggest beneficiaries of a rising rate environment, giving them more spread and more margin to work with. So if that is starting to come into doubt today, then obviously we've seen perhaps a high water mark on the financials, at least for now. So the financials really drove the S&P lower today by the tune of almost 3.7%. Fairly substantial move. Okay, for the next couple of minutes, I want to focus on the Dow and the S&P, and then we'll get over to the other opportunity. So starting with the Dow, again, from a top-down perspective, what we've been talking about for several months now is that we've had this historic level of exhaustion on the monthly chart, where we have this runaway market. For every parabolic market move like we have like this, there is the unfortunate side effect, which is called the hairy back. And this is what we have on the side of any parabolic chart that you look at, is that when we get into fear of missing out or parabolic moves like this, it tends to be very painful on the other side of that. So we can quantify this using fractal energies here, different time frames on the monthly, on the weekly, as well as on the daily. And we can kind of put together a piece of what should be happening. And this is why for the last couple of months I've been talking about the fact that, okay, good, we've gone into a new market character, which has gone from quiet and trending to the upside to sideways and volatile now. So this is precisely what we should be seeing, is days like today, which are nirvana for a true trader. Now, all of this extreme volatility that we're seeing, and all of this, I mean, if you read websites or watch the news today, you'll be scared to death. But this is precisely what needs to occur, regardless of what happens next to the market, whether or not it breaks higher from here or whether it continues to go lower. Either case, we have to see this type of market action right now. So it's doing exactly what it needs to do. And that is recharging all of these exhausted time frames. Recharging all these exhausted time frames. We've got a ways to go before the monthly chart is ready to go again. And we've seen this type of move before, and it takes a few months for this to work itself out. Perhaps we're going to have another one of these again, or it could even start to transition into something like this. Again, we don't want to rule out either outcome at this point, because that's the way that sideways and volatile will escape the price pattern, either to the upside or to the downside. So we'll look for clues to let us know which way this is going to go. Now, as we zoom into the daily chart now, we can see that what was formerly a nice little pennant, the price has actually dropped out to the downside. So I would say there's a good shot right now we're going to get a retest of the lows. And what I'd like to see personally, and I've said this before, is I'd like to see an undercut here. An undercut below the February lows would bring out all sorts of panic. So you haven't seen anything yet if you thought today was panic. So we could see a really nice undercut, and that is going to drive the volatility indices. So let's look over at the VIX really quickly here. And that will give us probably not as high as the February low, but still we should get into the 30s or so, and that's going to give us some very workable volatility. It's going to allow us to get back in the option selling game again. So more on that in a minute. Continuing on with the Dow, the issue with the Dow today, and again, look at this. It's rare when we see all 30 declining member stocks. But look at the two that have taken the biggest hit on the chin are Caterpillar and Boeing. So two of the top price-weighted members of this price-weighted index got hit on the chin today, and this is why the Dow just got absolutely destroyed to the downside. So again, getting back to the chart, we now have a series of lower highs and lower lows. We don't have any exhaustion right now on this downside move. It's going to be a high probability that we're going to see at least a retest of the lows of February, or perhaps at least a test of this 200-day moving average, which has been a long, long time since we've been anywhere close to that 200-day moving average. It was actually back here in the Brexit move. The Brexit move of 2016 was the last time that we saw the 200-day moving average tested. Now let's move over to the S&P 500. So same comments apply towards this index as the Dow. So zooming in on this chart, you can see that we had almost a double bottom here, kind of a tweezer bottom that tested the 200-day moving average back in early February. And now, since we've undercut this level here at about 2650, it appears that the next stop is the retest of that level. And again, what I'm hoping for is an undercut, a screaming undercut that induces panic and gives us some volatility to work with. Now, why would I want something draconian like that? Well, from extreme moves like that, typically what you end up doing is you get the majority of the traders on the wrong side of the tape. Whenever you see extremes, absolute extremes, it's almost a guarantee that the average retail trader, and in fact several institutional traders, will be on the wrong side of the tape and usually will make the wrong decision. If you can keep a calm head during extremes like today, and perhaps if we retest these bottoms, this is where the magic edge is really found. So I know Don's been talking about this 2682 level for quite some time, and that finally gave way with gusto today. So once it got going underneath there, that's when things started moving, as well as, let's switch over to the expected move. This is something that we track every week. Here's the weekly expected move on the spiders in this case, and you can see that that was tested on Monday, and that ascending trend line held. And then today the expected move was blown through in the pre-market, and this did not have a chance. So once you blow through that expected move, weekly level, say goodnight to this. Now, speaking of expected move, here's the interesting part, is if we go out to, let's go out to the SPX in this case, and don't forget that next Friday is Easter Friday, so that is a market holiday. So we have 7 days to go before 29th of March, which is that Thursday. So the quarterly options here have a 78-point expected move. So if we take our current price right now, which is 2643 on the cash index, and if we subtract 78 points from that, which is our almost 79 points at this point, we're going to come up with a figure of 2565. So back to the cash index, 2565 is going to be just below, there's 2565, is just below the 200-day moving average, and it's also going to be just above the lows for February. So this is kind of our target for next week. And who knows, you'd be surprised, days like today, we could see another one like this tomorrow, and we could end up getting there a lot quicker than 1 week. Now, you might say to this, hey, you're not giving the upside any benefit of the doubt right now. And that's true, because right now what I'm looking at is the fact that we've seen a higher high go to a lower low. So even if we do bounce up from here, some kind of a dead cat bounce or something, right now we still have the trend to the downside with undercutting these lows. So right now the trend is still featuring the downside. So if anything like this happens where we have the price setting up with coming down here to bounce and then sets up a higher low and then a higher high from that point, then we'll start to look to upside targets. But for right now, it looks like a retest of the lows, and this is a very common pattern. If you go back on just about any of these heavy corrections that we've had over the past, just about all of these have featured a retest of the lows. So go back through all of these, and we almost always universally have a retest of the lows. Usually takes anywhere from 4 to 6 weeks for that to occur. We're just about on time for that. All right, let's get over to part 2 now, which is the swing trades. You might say, well, look, the price has already moved down so far. Where's my opportunity in this? Well, we are going to look to, again, sell premium as we get down to a panic low, but we're not quite there yet. So we'll talk about that in a subsequent report. But in the meantime, we definitely have some nice opportunities with stocks that have gone just a little bit too far, a little bit too fast. Boeing is a good example of this. So here's Boeing setting up with a lower high and a lower low. This is where we finally had a change in polarity on Boeing. So Boeing all the way up here has not featured any kind of a daily downtrend until now. And so we're starting to see these one-day results like Boeing in and out of this in one day for about 45% return on capital. Another trade that Don sent out in the room recently was Morgan Stanley. Again, Morgan Stanley, a big beneficiary of today's downside, and we set up an in-out put spread vertical for this one. And in for 92 cents, out for $1.42, which is a 54% return on capital. Now, in this type of market, we can't use the same type of skills that we looked at when we were playing bullish spreads along the way up here. So things like flags, taking breakouts and flags and types of trades like that, it all makes sense. It's all very linear, but you have exactly the opposite on the way down. You have to enter before the move. So think of it this way. You have to be in it to win it already. You can't chase these things down. You can't enter them at the bottom, because what you'll find is that most of these moves will bounce back up again as soon as you enter them down at the bottom. This is going to be the entry point. So you have to learn how to sell the rips in this type of environment. So instead of buying the dips, you're selling the rips. You're looking for movement to the upside. And if you want to, you can look for smaller time frame reversals in there to improve your edge as well too. Now, the last thing I want to bring to your attention in today's market is the intraday opportunities. So intraday opportunities, and they don't need to be all that difficult, because what you'll see in these types of moves is just a continual flag environment. So what I've got here is a tick chart on the S&P 500, and you'll see an initial thrust down, and then you'll see what's really is just a flag. This is just a bear flag. And all the way along here, you're going to see these types of movements. So you'll see primary moves down, you'll see flag patterns back up again, and each one of these, again, ascending patterns break to the downside. So we're just using simple ways to trade this to improve our edge intraday. So it doesn't matter whether you're looking at the ES in this case. If we look at we can look at the Nasdaq as well too. The Nasdaq is going to have the same type of patterns here. Ascending flags, bear flags breaking to the downside. Ascending bear flags breaking to the downside. Ascending bear flags breaking to the downside. You'll see it all day long in this type of environment. So what you have to be careful of is not trying to sell the lows of any of these moves. Again, wait until the flag breaks, and that's going to be your entry with the best reward to risk. And that matches the character of the price action. So again, these are days that we all dream about when we have movement like this, when we have 72-point days on the S&P or 700-point days on the Dow. This is where maximum opportunity is found. So regardless of whether you're a swing trader or an intraday trader, there's plenty of opportunity to go around, and it offers a nice balance to all those quiet, no volatility days that we've had over the last 2 years. And this is what we have when volatility hits. Hey folks, before you go, I want to talk to you for just a minute about the TheoTrade Live Return of the Trader event. Why are we calling it the Return of the Trader event? Well, because we believe, and we've already seen, volatility returning to the market as of February and March, and we think it will continue going into the rest of this year. So there's no better time than now to get prepped for all this volatility than at this event, because this is what we're going to be focusing on. So look at all these happy people from our last event. You can be one of them at the next event, which is coming up the beginning of May. So May 3rd, 4th, and 5th. I'll get into that in just a minute. Right now for members, the members are getting pricing of $1,100. So you've got until April 1st to get this price level. Otherwise, it's going to end up going up again. And also, don't forget that the event is limited to 200. So once we do sell the 200th ticket to this, we will shut down admissions to this event. All right, so where is it at? When is it going to happen? All those things. So it's going to occur at the Scottsdale Resort at McCormick Ranch in Scottsdale, Arizona. This is where we were last September. It is a really, really nice place, and I'll talk to you a little bit more about that in just a minute. So who's this for? Intraday traders, swing traders, income traders. We've got something for everyone here. So again, on the 3rd of May, May 3rd, is where we have the event registration and the happy hour. So you can meet all of us live, can corner us in a room and ask us questions. And drinks are on TheoTrade, so don't forget that. We also have a quick event for you guys with Jeff and Don coming up. On Friday, May the 4th, this is when everything kicks in here. First session of the day will be Return of the Trader by Don Kaufman. And then we'll shift into Jeff Bierman. Professor Jeff Bierman will go into negotiating intraday volatility shifts, something that's very, very important in this type of volatility. The last session in the morning will be Perfecting Your Nasdaq and Intraday Trading Style by Tony Rago. And after lunch, I'll come on board with Fractal Analysis Intensive. So we're going to be talking about fractals in the context of what's happening in the market today. And then we'll go into Taming the Trend Day by Corey Rosenblum at the end of that day. So that is Friday, May 4th. So it's a market day. And then we will have the second day, Saturday, May 5th. And we're going to go right back into Don first thing in the morning. Probability and Profitability in Trading by Don. Price Action Intensive, again by myself. So I'm going to be going into specifics of reading price action. Tony will go into more about intraday trading, the Nasdaq E-mini. Don Kaufman will go into the state of the markets. We'll talk to Corey for creating your game plan for the next trading day. And then we'll have all of us up front, closing ceremonies, final giveaways, and everybody is sent home at that point on Saturday evening. So you might be saying, well, that all sounds great, but what's in this for me? Well, we've got 9 reasons here as to why we think this is a good event for you. First of all, just hearing repetition, practice and repetition over the next 2 days as we conduct this seminar. You're going to hear the same things again and again, and pretty soon you'll start to think in the same way. Don't forget that almost all of us trade at home or in our office by ourselves, and many times we don't feel like we're connected. Well, this is where we can also show you that you're part of a bigger community. You're going to hear from others and understand what they're doing in today's market. And by doing that, you'll discover your one-of-a-kind style. This is where you form your own trading strategies. You're going to be talking to not only the instructors, but also other people in the room to gain their wisdom, get their approach from things. Understand how to risk manage in today's market, play it safe, and play it profitably. And make sure that you're not trading just out of boredom. We're not going to get boredom in this year's market, but making sure that you're looking for just the best setups and then being decisive about taking those setups. And then finally, ultimately, this is what we're all after, is that peace of mind and freedom that all of us are looking for through individual trading. Now, this is not some event where we just sit up at the front of the room and put a virtual wall in between you and us. You're going to meet all of us. You're going to talk to us at the breaks. We are here for you, to talk to you. So Don, Jeff Bierman, myself, Tony Rago, Corey Rosenblum, as well as your other 200 attendees. Now let's talk about the actual location, the Scottsdale Resort at McCormick Ranch. And I'm particularly excited to talk about this because there's some really cool things about this place. So it's pretty easy to get to. It's not that far from the airport. It's a world-class airport. You should be able to get direct flights in just about regardless of where you live. Let's talk about the venue for a second. This is what a typical room looks like, and I do want to mention, I mention this every time I talk about this event, but I love the chairs that they have here. The chairs have got armrests. You're not going to be sitting here playing elbow wars with a guy next to you. They recline, so you're going to be comfortable all day long. You're not going to be sitting on some little narrow, tiny banquet chair that's going to wear you out after 3 hours. The weather should be excellent at this time of year. There's all kinds of events and outdoor activities that they have at this particular ranch. Now let's talk about the meals as well too. This is where, again, I get excited about this because breakfast, this is not just any breakfast. This is a really, really good breakfast served on Friday and Saturday, as well as the lunch. So we bring in the lunch. We bring in the lunch here for you guys. Bring in the lunch. So both days we're going to serve you breakfast and lunch. For dinner, you're on your own because a lot of people want to go explore the area. But what we find is a lot of people get together as groups anyway and go out to eat for dinner. So anyway, get your ticket right now. Make sure you get it in before April 1st to be able to get that preferred pricing. Don't miss this event. This is a great time. There's a lot of terrific information that's brought out there. Everybody walked away with a smile on their face last time. We want you to be one of those people to join us as well too. Hope to see you out there. Take care.